All right, let's jump right into this explainer on the highly anticipated IPO of Sunshine Silver Mining and Refining. Look, if you track the critical minerals space, you already know this is a massive deal. We are talking about a historically proven U.S. asset that's gearing up for a huge restart, fresh off pulling in a massive $310.5 million initial public offering.
So here's the roadmap for today. We're breaking down the asset overview, the market demand and products, project financials and costs, management and shareholder alignment, and finally, the timelines and key risks. Basically, we're unpacking everything from structural market deficits and the SK1300 financials right down to the very real execution risks of pre-production mining.
Kicking things off with Section 1, the asset overview. Let's look at the geography and pedigree.
Our journey starts right in Idaho's famous Silver Valley. Now, 360 million, that massive number, that is the historical ounces of silver this exact site, the Sunshine Mine, cranked out before shutting down in the early 2000s. The Electrum Group swooped in and acquired this complex back in 2010. And honestly, the pedigree it holds in the mining world is just undeniable.
But you know what's truly wild about this asset? The absolute lack of bureaucratic red tape. We all know the U.S. regulatory environment can easily eat up a decade just to get a single shovel in the ground. But SSMR? They are fully permitted for restart. No new environmental impact study required. Zero. Factor in the 104 million ounces of indicated silver resources, plus the fact that Electrum has already sunk over $200 million into modernizing the infrastructure since 2010, and you're looking at a project that is literally primed and ready to move.
Moving on to Section 2, Market Demand and Products. Specifically, we're talking silver and antimony.
Because let's be real, silver isn't just for jewelry anymore. To put it into perspective, your average electric vehicle requires roughly 0.6 ounces of silver. And modern solar panels, they demand up to 13 milligrams of silver for every single watt of power they generate. We are looking at a global silver market that's barreling into its 6th consecutive annual supply deficit. And it's being driven entirely by these massive green energy and industrial applications.
So the crucial takeaway here is the structural deficit for both primary silver and their secondary product, antimony. Antimony is absolutely vital for national security, munitions, flame retardants, you name it. And right now, the U.S. is almost entirely reliant on restricted foreign imports to get it. SSMR plans to build a domestic antimony plant that could supply up to 60% of U.S. demand. That is a game changer. It gives them a critical minerals angle that pure-play silver peers simply don't have.
And then there's the third piece of the puzzle, copper concentrates. Copper is literally the building block of the global power grid, and as we know, demand from AI data centers is absolutely explosive right now. But what gives SSMR an edge here? It's their clean, high-purity geology. By utilizing on-site upgrading, they can actually produce copper concentrates without toxic elements like arsenic. This lets them completely bypass the standard $80 to $100 per ton treatment charges that usually just devour a miner's profits.
All right, Section 3, Project Financials and Costs. Let's dig into the SK1300 report.
Before we start benchmarking them against their peers, we really need to understand a key metric, all-in sustaining cost, or AISC. Basically, this lets us measure exactly how efficiently SSMR plans to pull these metals out of the ground. It factors in the whole shebang, from mining costs all the way to sustaining capital and reclamation.
So SSMR's projected AISC over the life of the mine comes in at a highly competitive $18.81 per ounce. That plants them right between producing rivals like Hecla and First Majestic. But, and this is a massive but, you have to remember that SSMR's numbers are study projections. Hecla and First Majestic are reporting actual real-world operation costs. And in the mining industry, projected costs are almost always a floor, definitely not a ceiling.
Looking at the base case economics from their technical report, the numbers are seriously substantial. We're talking about an impressive after-tax net present value of $1.43 billion using a 5% discount rate. And keep in mind, that calculation assumes a silver price of $46.36 per ounce. That gives the project massive leverage if spot silver stays up near those recent $68 to $70 highs.
However, we always have to look at the downside, right? If drilling disappoints and they end up relying solely on their indicated resources, that NPV drops off a cliff down to $270.4 million. The mine life shrinks from 24 years to just 10. So it definitely shows a much thinner margin of safety if the geology doesn't behave exactly the way their base case models are predicting.
Let's move to Section 4, Management and Shareholder Alignment. Let's see who's steering the ship.
The big theme here is owner-operator alignment. The Electrum Group, which is governed by Chairman Dr. Thomas S. Kaplan, holds on to a dominant 60% voting power post-IPO. For you as an investor, this means you are buying into a strictly founder-controlled enterprise. Make no mistake, they have massive skin in the game.
And the executive team reflects that alignment perfectly. You have CEO Heather White bringing 30 years of operational experience to the table. And get this, out of her $4.24 million compensation package, roughly 93% is tied directly to stock, options, and bonuses. Partnered up with CFO Andre Van Meekerk, they boast a totally clean track record with no known SEC investigations. The bottom line, the executive team only wins if the stock actually performs.
Finally, Section 5, Timelines and Key Risks, the reality of pre-production.
Okay, time for the most important reality check of this entire explainer. The company currently has zero operating revenue, none. They reported a net loss of $34.7 million in 2025. Why? Well, because the targeted commercial restart for the Sunshine Mine isn't happening until late 2028. You're going to be waiting years for that first ounce of silver to actually be poured. And that, frankly, is the true cost of admission here.
So you might be wondering, what is that $310.5 million IPO actually paying for right now? Well, it's primarily funding 3 major feasibility studies. One for the mine restart, one for the antimony plant, and one for the refinery. In plain English, SSMR raised money to finish their engineering homework, meaning substantial capital needs and potentially some serious dilution still stand right between today and actual physical construction.
Which brings us straight to the valuation. At its $13.50 IPO pricing, SSMR was valued near $1.9 billion. That is a very clear premium over its technical base case NPV of $1.43 billion. So the market is explicitly paying for growth, they're paying for critical mineral optionality, and they are paying for flawless execution, none of which physically exists quite yet. When you consider all those required feasibility studies, the heavy execution risks of underground mining, and that delayed fuse ticking toward a 2028 restart, it leaves us with this final thought. Is the promise of this critical minerals hub worth the premium right now, or are investors paying $1.9 billion just for the map? Thanks for tuning into this explainer, and we'll see you in the next one.